What if your investments paid you every single quarter, whether the stock price goes up or down? What if you could build a portfolio that sends you $500 a month, then $1,000, then $3,000 in cash just for owning shares? That's exactly what dividend investing does. And some people have built portfolios that pay them $50,000 to $100,000 per year in dividends alone. They're getting paid just to own stocks. Today, I'm going to show you exactly how to build passive income with dividend stocks, even if you're starting with just $100. Let's get into it. Before we dive in, let's be clear about what dividend investing actually is. When you own shares of certain companies, they pay you a portion of their profits every quarter. This payment is called a dividend. You get cash deposited into your account just for being a shareholder. Think of it like owning a piece of a business. If that business makes a profit, you get your share of it. And here's the beautiful part. You get these payments regardless of what the stock price does. The stock could go up 20%, you get dividends. The stock could go down 10%, you still get dividends. The stock could stay flat, you're still getting paid. This is different from growth stocks like Tesla or Amazon, which don't pay dividends. With those, you only make money if the stock price goes up and you sell. With dividend stocks, you make money from the stock price appreciation and from the cash payments they send you every quarter. This is how you build real passive income. Let's break down exactly how this works with a real example. Coca-Cola, KO, is a classic dividend stock. Let's say Coca-Cola stock is trading at $60 per share, and they pay an annual dividend of $1.80 per share. If you buy 100 shares, that costs you $6,000. Every year, Coca-Cola will pay you $180 in dividends. That's a 3% dividend yield. $180 divided by $6,000. Most dividend stocks pay quarterly. So with Coca-Cola, you'd get $45 in March, $45 in June, $45 in September, $45 in December. That's $180 total for the year. The money gets deposited directly into your brokerage account. You can then withdraw it and spend it, reinvest it to buy more shares. Let it sit as cash. Important dates to know: when the company announces they're paying a dividend. The cutoff date. You must own the stock before this date to get the dividend. When the money hits your account, that $180 per year is passive income. You don't have to work for it. You don't have to sell anything. You just own the shares and get paid. And if you reinvest those dividends to buy more shares, those new shares also pay dividends. This creates a compounding effect that builds wealth over time. Let me show you what I mean. This is where dividend investing gets really exciting. Instead of spending your dividend payments, you use them to buy more shares. Those new shares pay dividends too, which you use to buy even more shares. This is called dividend reinvestment, and it's one of the most powerful wealth-building strategies out there. You invest $10,000 in dividend stocks with a 4% yield. Scenario 1. You take the cash dividends. Year 1. You receive $400 in dividends. You spend it. Year 5. You've received $2,000 total. You still own $10,000 worth of stock, assuming no price change. Year 20. You've received $8,000 total. You still own $10,000 worth of stock. Scenario 2. You reinvest the dividends. Year 1. You receive $400 and buy more shares. Your portfolio is now worth $10,400. Year 5. Your portfolio is worth $12,167. Year 10. Your portfolio is worth $14,802. Year 20. Your portfolio is worth $21,911. Same starting investment, same dividend yield. But reinvesting more than doubles your portfolio value, and that's not even counting stock price appreciation. If the stock price also goes up 6% per year, your portfolio would be worth over $60,000 after 20 years. Most brokerages have a DRIP option, Dividend Reinvestment Plan. Turn this on, and your dividends automatically buy more shares. You don't have to do anything. Fidelity, Charles Schwab, Vanguard, Robinhood, they all offer this for free. While you're building your portfolio, reinvest everything. Let it compound. Once your portfolio is big enough that dividends cover your expenses, then you can start taking the cash. But in the accumulation phase, reinvest, reinvest, reinvest. Not all dividend stocks are created equal. Some are amazing long-term investments. Others are traps that will lose you money. 1. Dividend yield, but not too high. Dividend yield is the annual dividend divided by the stock price. A 3 to 5% yield is solid. A 6 to 8% yield is attractive, but do your research. A 10% plus yield is often a red flag. Why? If a stock pays a 12% dividend, something's probably wrong. The market knows something you don't, and the stock price has crashed, making the yield artificially high. These high-yield traps often cut their dividends, and you lose money. The best dividend stocks don't just pay dividends, they increase them every year. Look for companies that have raised their dividend for 10-plus consecutive years. These are called dividend achievers. Companies that have raised dividends for 25-plus years are called dividend aristocrats. There are only about 65 of these. Examples: Johnson & Johnson, Procter & Gamble, McDonald's, Coca-Cola, 3M. These companies have survived recessions, market crashes, and still kept increasing dividends. That's stability. This is the percentage of earnings the company pays out as dividends. A payout ratio of 40 to 60% is healthy. The company is paying you well but keeping enough profit to reinvest in the business. A payout ratio over 80 to 90% is risky. If earnings drop even a little, they might have to cut the dividend. A payout ratio over 100% is a major red flag. The company is paying out more than it earns. That's unsustainable. Does the company have consistent revenue growth? Low debt levels? A competitive advantage? Products people will always need? You want boring, stable businesses. Companies that sell toothpaste, soda, insurance, utilities. These might not be exciting, but they're reliable. Don't put all your dividend stocks in one sector. Spread your investments across consumer goods, Procter & Gamble, Coca-Cola; healthcare, Johnson & Johnson, AbbVie; financials, JP Morgan, Bank of America; technology, Microsoft, Apple; utilities, Duke Energy, Southern Company; real estate, Realty Income, Digital Realty. This protects you if one sector struggles. Now let's talk strategy. How do you actually build a dividend portfolio from scratch? If you're new to this, don't try to pick individual stocks right away. Buy dividend-focused ETFs instead. These are funds that own dozens or hundreds of dividend stocks. Top dividend ETFs: VYM, Vanguard High Dividend Yield, 3.0% yield, owns 500-plus stocks. CHD, Schwab US. Dividend Equity, 3.5% yield, focuses on quality dividend growers. DGRO. iShares Core Dividend Growth, 2.4% yield, targets companies that grow dividends. VIG, Vanguard Dividend Appreciation, 2.0% yield, only companies with 10-plus years of dividend growth. These give you instant diversification. One share of SCHD gives you exposure to 100-plus dividend-paying companies. Start here. Build a foundation. Don't invest all your money at once. Spread it out. Invest $500 per month, or whatever you can afford, on the same day every month. This averages out your cost and removes the stress of trying to time the market. Once you have a base of dividend ETFs, start adding individual stocks for higher yields and dividend growth. Here's a sample beginner portfolio. 50% dividend ETFs, SCHD, VYM, 50%. Individual dividend stocks, pick 8 to 12 companies from different sectors. Johnson & Johnson, J&J, healthcare, 3.0% yield. Procter & Gamble, PG, consumer goods, 2.4% yield. Realty Income, O, real estate, 5.3% yield, pays monthly. AbbVie, ABBV, pharmaceuticals, 3.5% yield. Microsoft, MSFT, Technology, 0.8% yield. But growing fast JP Morgan, JPM. Banking, 2.4% yield. Turn on Drippy for every stock and ETF. Let those dividends compound. This isn't a get-rich-quick strategy. This is a build wealth slowly strategy. It might take 5 to 10 years before your dividends feel significant. But that's when the magic happens. Your dividends start paying for groceries, then utilities, then rent. Eventually, they can replace your entire income. Let's get practical. How much do you need to invest to make real passive income? To make $1,000 per month in dividends, that's $12,000 per year. With a 4% average dividend yield, you'd need $300,000 invested. I know that sounds like a lot, but here's how you get there. If you invest $500 per month in dividend stocks averaging 10% total return, 6% price appreciation, plus 4% dividends. After 10 years, $102,000 portfolio, $340 per month in dividends. After 15 years, $174,000 portfolio, $580 per month in dividends. After 20 years, $379,000 portfolio, $1,265 per month in dividends. If you invest $1,000 per month, after 10 years, $205,000 portfolio, $683 per month in dividends. After 15 years, $349,000 portfolio, $1,163 per month in dividends. After 20 years, $759,000 portfolio, $2,530 per month in dividends. See how this works? The first decade is slow. The second decade is where you build serious wealth. And remember, these numbers assume you're just investing consistently. They don't account for salary increases, letting you invest more bonuses or windfalls you add to the portfolio dividend growth. Most dividend stocks increase payments every year. In reality, you'll likely hit your goals faster. $1,000 in annual dividends. Covers small bills, $5,000 in annual dividends. Covers utilities and groceries, $12,000 in annual dividends. Covers rent or mortgage, $30,000 plus in annual dividends. Real financial freedom. This is achievable. People do it every day, but it requires consistency and patience. Before we wrap up, here are the biggest mistakes dividend investors make. 1. Chasing high yields. A 10% plus yield is usually a red flag, not an opportunity. 2. Not diversifying. Don't put everything in one sector or one stock. 3. Forgetting about taxes. Dividends are taxable income. Use tax-advantaged accounts like Roth IRAs when possible. 4. Panic selling during downturns. Stock prices drop. That's normal. Keep collecting those dividends. 5. Ignoring dividend cuts. If a company cuts its dividend, that's often a sign of bigger problems. Reevaluate whether you should hold it. Avoid these mistakes and you'll do great. Let's wrap this up. Dividend investing is one of the best ways to build passive income. You get paid just for owning shares, and if you reinvest those dividends, the compounding effect builds serious wealth over time. Start with dividend ETFs like SCHD or VYM. Dollar cost average. Reinvest everything. Be patient. In 10 to 20 years, you could have a portfolio generating thousands of dollars per month in passive income. Here's your action step. Open a brokerage account this week if you don't have one. Buy your first share of a dividend ETF. Just one share? Get started. If you found this valuable, hit that subscribe button and turn on notifications. Next video, we're diving into tax-efficient investing strategies. Drop a comment. How much dividend income are you earning per month? Or if you're just starting, what's your goal? I read every comment. Thanks for watching, and I'll see you in the next one.
Before we start, I put together a free PDF called The Money Leaks Checklist and a Tamas 2025 edition. It breaks down the 10 biggest places people lose money without realizing it and how you can plug those leaks today. If you want to stop wasting cash and redirect it into savings or investments, grab it free. The link is in the description and pinned comment. Download it now. It takes 10 seconds, and at Paul glance you're persuasive. And it might be the most profitable thing you do today.